Hi. Let us try to solve this problem. A $20 million investment is financed by issuing 15,000 units of 5-year annual bonds with yield to maturity of 5% and coupon rate of 7%. The rest is financed by issuing stocks that sell at $20 per share. The project has a life of 5 years and has a salvage value of $3 million. The company's beta is 2 and the yield on treasury note is 1%. The market has an expected return of 3%. Okay. How much of the investment is financed by debt and how much is financed by equity, right? How many stocks were issued, find the cost of capital. We want to find the NPV and IRR. Assuming that the expected revenue of $6 million in the first year and it grows at 2% per year. The cost is fixed at $0.5 million annually. Tax rate is 35% and the salvage value is $3 million at the end of the life of the project. Okay. So first we're going to look at, how much is the price of the bond, right? So here's the term of the bond. The coupon rate is 7%. That means it pays $70 per year. The face value is of course 1,000 and the yield to maturity is 5%. So the present value or the price of the bond would be equal to, rate is 5%, number of periods is 5 years, payment is 70, future value is 1,000. Okay, so each bond is selling for 1,086. Okay, now if the investor issued 15,000 units, then that means that the total debt would be 15,000 times 1,000, so it's 16 million, right? Now this means that the total equity that has to be financed would be, the original 20 million. Okay, that's 20 million. Right. Okay, let me see here. Equals 20 million minus the debt. Okay, so that means that they have to source 3.7 million in equity, right? Since it is selling at $20 per share, so the number of shares would be 3.7 divided by 20. Okay, so the number of shares would be, 185,000 shares. Okay, they'll have to sell 185,000 shares of stocks. Okay, now let's get the cost of capital. The cost of debt is, the yield to maturity. Tax rate is 85%. So the cost of debt, the weight of debt would be, the weight of debt would be 16 million divided by the 20 million. Right, so 81.49% is financed by debt. Okay, let's get the cost of capital, the cost of the equity. Here we're going to use the comp M. So we say that, the cost of equity would be the risk-free rate plus beta times the market risk premium, which is the return on market minus the risk-free. Okay, so it turns out to be 5%. So the weight of equity would be, the 3.7 million divided by 20 million. Okay, which is also the same as 1 minus 81% here. So now the weighted average cost of capital would be the cost of debt times, 1 minus the tax rate times the weight of debt. Okay, plus the cost of equity times the weight of equity. There. So it is 3.57%. Right. So now here the investment cost 20 million and according to makers this will be the depreciation schedule. Okay, right. So that means that the depreciation in the first year will be 20 million times the depreciation rate, and we can now get the depreciation every year, right? Okay, now the book value in year 0 will be 20 million. The book value in year 1 will be 20 minus the 4 million. So we can now get the book value every period. Okay, now we have the salvage value of 3 million. So that means that, you know, the after-tax salvage value at the end of 5 years would be, you know, 3 million minus the tax on gain. Now you're paying 35% on the gain, on the capital gain. Okay, so you're selling something for 3 million, something that is only worth 1.1 million. So that's your gain. Okay, so the after-tax salvage value would be 2.35 million. Okay, now here the revenue in the first year is 6 million, and it is expected to grow at 2% every year. So we say that it's gonna be 6 million times, you know, 1 plus the growth rate. Okay, equals 6 million times 1 plus the growth rate. Okay, so that means that this is the revenue every year. Okay, the cost is constant at 500,000 every year. Therefore, the gross profit would be the revenue minus the cost. Okay, now we take out the depreciation. We already calculated the depreciation here. Okay, so we say 6 million less 4 million. That's, you know, gross profit less depreciation. That's your earnings before interest and taxes. Okay, so now we have the EBIT. Okay, now we're going to take out the tax. Okay, we're going to take out the tax on, you know, remember that there is no interest expense here, so we're going to take out the tax on earnings before tax. Okay, so we say here the tax rate is 35%. Okay, the tax rate is, you know, 35% times, we're multiplying it with the EBIT. Okay, so this is the tax that they're going to pay every year. Okay, here in the second year they have a negative tax, so that means they're going to get a tax rebate from the government. So net income will be EBIT less the tax. Okay, there. Now we're going to add back the depreciation because this is a non-cash expense. Okay, that's the depreciation here. We add back the depreciation. We add the after-tax salvage value, and it only happens at year 5. Okay, and we can get the net cash flow. Okay, so we say net income plus the depreciation plus the salvage value. No? Okay, so you can say that there's 0 salvage value, 0 here. Okay, now in year 0 we are spending, you know, 20 million, so that's the total investment cost. Okay, we're putting it as a negative number here. The weighted average cost of capital, we already calculated it. We're going to use it to get the NPV, right? So we say here that, you know, the NPV would be equal to, we say equals this plus NPV. Wow, the rate is 3.57, and then you get the values of this. Okay, now that's 4.8 million. The NPV of the project is greater than 0. That means the project is good. Okay, now let's get the IRR. Say IRR would be, okay, say the IRR is 11.4%, which is really good. This is bigger than, you know, the weighted average cost of capital, so that means the project is good. This is bigger than 0, so that means the project adds value to the company. Okay, so I guess that's it. We are